So now we're going to focus on when to buy. Because you got to know when to buy too. Buying is harder than selling. Because buying is, as we saw earlier, the market comes down, it comes right back up, and it does it in a hurry. And when markets bottom, everything is so negative. Everything is horrible news. People are jumping off buildings. People are committing suicide. There's not going to be anything that will encourage you to buy stocks at a market bottom. So you have to have some data. Somebody says, I need to buy stocks. Well, I'm going to give you a couple of those now. You go, yeah, I got to buy stocks. Whether I like it or not, today's the day to buy. And with that, I'd like to take you way back in time. A lot of you know this. This is my 13-week rate of change indicator. It's a technical indicator that says if in the last 13 weeks, I'll explain that number a little bit, prices are negative by minus 15%, I want to buy stocks. There's examples going all the way back into the 30s. Now, why 13 weeks? Because a quarter of the year. In fact, if you think about the stock market for just a little bit, the big number in the market would be 52 weeks, an annualized rate of change, and then each quarter, 13 weeks and 26 weeks. So the number I like to use is 13 weeks. And if you think about that a little bit farther, how many cards are there in a deck of cards? 52. How many weeks in a year? 52. How many cards within a suit? How many diamonds do we have? 13. Just like the calendar. In fact, if you count up the pips, those are the dots on cards, we have the same number of pips on a deck of cards that we have days in a year. Which proves once and for all that the stock market is nothing but a deck of cards. But I do think that 13-week period is important because it's earnings announcements, isn't it? They announce earnings every 13 weeks. That's the big cycle of the stock market, 13 and 26 weeks. Not because of a Fibonacci number or some mystical, magical thing, because that's when earnings are reported. If earnings were reported every 27 weeks, 27 weeks would be the big cycle in the stock market. So if prices are lower this week than 13 weeks ago by 15%, I want to buy stocks. Sometimes it's a little early. Sometimes it's just absolutely spot on. But in each instance, we've always gone higher. Coming forward from 1946, big bull market began, and there's the problem, we don't get any bicycles for a long time in it. So we need some other things, but when this does happen, we'll come forward now, Harry. 1957, oh, you missed the week of the low by about 4 weeks. 1962, you missed it by 1 week. You had one more week to get in and buy stocks. That's pretty good, remarkable timing. If we look at 1966, it was 1 week from the actual low closing was on that week. The next week we made a little bit lower low and prices rallied. Here's the strength of the index. The strength of the index is this. Virtually all other bull market buy signals I know are trend-based. So the market does this and you're buying here on a breakout or getting above a moving average. You missed this, which is the big explosive move in the marketplace because you're scared to death. But the 13-week rate of change says, no, step in and buy. And I may be a little early, but I want to step in and buy. In this instance, the S&P did get negative, the Dow got negative 15%, the S&P didn't, and the S&P gave a buy signal here, and the Dow didn't. So I actually, for this indicator, look at both the S&P and the Dow, either one going negative by 15%. There was a 1974 low a little early. We've seen that, but if you bought stocks there, great bull market. 1981, a little early by quite a bit actually, but again, it was quite profitable. 1987, the week of the low. There's the 1987 buy point. 1990, 1 week from the low, the absolute low of the marketplace. That's astounding. I don't know how many of you have tried to buy a market low before. It's really hard to call the exact low of a market with anything. And even if you're early, I don't care because it gives me the opportunity to accumulate stocks as opposed to chasing stocks and trying to buy them as they make higher and higher. Because the trend following techniques in the market have the markets bottom, come up. You missed all the explosive, where the really easy money is made, is buying into that weakness. And that's what this index allows us to do. There was a 1998 bottom, week of the low, 2011, week of the low, a little early in 2002, and then as the bull market began, 1 week from the low closing price, a nice rally, buy points profitable, bringing it up to date. A little early in 2008, the next one was right at the low, 2011, right at the low, you know, where we are now, we're way up here someplace. So the best technical bull market buy signal I can find is this really simple 13-week rate of change. And I've been using this since 1970. So there's a lot of out of sample data with it. All the buy signals from 1970 forward are things I've known about. This isn't like something we curve fit to figure out the markets of the past. This is what we've actually been using. Some of you, how many of you learned this from me already? A lot of you have, right? Yeah, it's been around a long time. So we know that it has a lot of legs to it. All we're going to do is take the close this week minus 13 weeks ago as a percentage. That's it. No rocket science math here, nothing fancy at all. If we've declined more than 15% in a quarter of the year, man, it's bad. And I think if we've declined 15% in a quarter of the year, our friends at the Federal Reserve are probably going to get a little worried about the market. And they're probably going to start to do something based on the evidence of the past. Something happens when prices get that negative that quickly. And that's what I think sets up the buy signal, why it is so effective. Oh gosh, we're going to talk about individual stocks right now. And good thing this is not a Sunday because sin sells. Stocks that are involved in tobacco, alcohol, guns, sugar, those stocks outperform other stocks. Whenever I go to a cocktail party, people want to know about high-tech stocks. You know, some are great, some boom, some bust, but on a long-term play, there's a group of stocks that way outperform high-tech stocks. They're what we would call stocks that are in gambling and guns and alcohol and all the things we all enjoy. A question?
Yeah, you mentioned the Fed. What about the unprecedented keeping interest rates so low as they have for so many years, and also the QE and all of that? How does that factor into all these?
So the question is, how does the low interest rates from the Fed and the QE, the money expansion of the Fed, how does that factor into everything? We've been in a bull market. And people that have fought the Fed saying, oh, they shouldn't be doing these things, they've been short, we might be long. So I happen to think the Fed usually knows what they're doing. So if they take action to encourage the economy, I think the economy will get better. I don't want to argue with them. I have argued with them too much in the past. That's what they're doing. If you want to get more advanced in your economic understanding, I would Google Lacey Hunt, L-A-C-E-Y-H-U-N-T. Lacey Hunt and Van Huizington have given the best economic forecast that I know of. They're both wonderful guys. Van's been a friend of mine for years. Read their work and you'll understand why the increase in money supply did not cause inflation. They're the only guys to have spotted that in advance. So, gosh, the Federal Reserve wants to have a regular economy, and they'll step in when it's too good or too bad. The Fed does what they should do. And again, I've come from a position of not trusting the Fed at all. To now saying, come on, after 53 years, we haven't had the crash because the Fed has made certain we haven't had a crash. So I'm one of the few guys that likes the Fed, I guess. Everybody in our business is all against the Fed. That's wonderful. They keep the game going, as I see it. Okay, well, no, go back to that. If we look at the individual groups of stocks, the number one performer, 6,280% gain, tobacco stocks, were the all-time great stocks. Philip Morris, now Altria. Oh, if you don't have Altria in your portfolio, you're smoking tobacco or something. I was like, my gosh, this stock has been phenomenal stock to own. There are other items other than tobacco now as well, but they're very smart management to get rid of the tobacco lawsuits, diversify and other stuff, phenomenal management. So as a group, if we look at the sin stocks, if you will, the vice stocks versus the other groups, the S&P 500, the sin stocks have always outperformed the market itself. So I know some people don't want to buy alcohol, tobacco, whatever. It's your choice. But if your objective as an investor is to maximize the return on your money, you want to be looking at consumer things where people, what does Warren Buffett have most of his money in? Coca-Cola. What's Coca-Cola made out of? Sugar. Where's the rest of his money? Dairy Queen. Have you ever been in Dairy Queen? I mean, what a brilliant guy. He had this comment, somebody asked, well, Dairy Queen's full of sugar and all this. He said, well, you know, I went into Whole Foods and nobody was smiling. You go into Dairy Queen, people are happy. Yeah, that's right. All the sugar high. Now, sugar may be the next tobacco. I suspect it might be. But people have weaknesses, and they buy this stuff. And as an investor, you know, you need to be thinking about where your money is, where the greatest rate of return is. If we look at the best groups in the markets, it really has not been high-tech stuff. And again, at the cocktail parties, they always ask me about what high-tech stock and what growth stocks. And I learned, because I asked these questions, I had to get an answer to them, so I learned a lot about it. Here's the stock market itself. That's the S&P 500. Notice it made its high after the crash in 2008 over here. But whoa, look at healthcare made a new high, and consumer staples made a new high way before the stock market itself did. And we don't think about consumer staples as being a group, but as the economy gets better, people go out and buy television, they buy more food, they go to Costco, they go to Walmart, they shop on Amazon, they buy more because the economy's better. So the most responsive things are when I can immediately take money out of my pocket and buy something now for $15 or $20 or $200. Not where I go out and buy a car or a house. Those are late in the game. The most responsive are going to be consumer staples. Starbucks is a good example of that. Anything where people have to consume it, they're out of it, oh, I need another cup of coffee. I use a bar of soap, oh, I need another bar of soap. Consumer staples have been a phenomenal group of stocks to be invested in. Healthcare as well. Healthcare leads the market by quite a bit. Been a great group to be in. If you're not in consumer staples, if you're not in a healthcare stock, you know, you're really not in the game. If you're trying to chase a hot stock, you might get it. I hope you do. But the odds of it, though, are not very good. They're not good at all. The average investor's return is down here at about 2%. That's where most of you in the room, maybe not this room because you guys have been with me for quite a while, most of you have, you're probably up a little bit higher. But the average investor, that's what their return is because they're in the wrong group of stocks and because they don't believe in upward drift. They're trying to dance in and out. If we look over here, the high returns have been energy, healthcare, information technology, consumer staples. There it is again. One of my all-time favorite stocks, we'll look at it in a little bit. Whenever I mention stock, I never even knew they were a company. It was like amazing stock performance of a consumer-driven item. So consumers drive the economy. We do it quicker so you can get the start of the bull market faster, and it'll top out before the market tops out. So it's a great group of stocks to be in. So age is good, like fine wine. We have various groups of stocks. The red one is companies that have been in business more than 20 years. One that have been in business 3 years or less don't do nearly as well, do they? On balance, they haven't done well at all. The more established a company is, the better they'll perform. So if you're buying companies that are brand new, they might be great, but on average, your odds of beating the market are substantially better with stocks that have been around for quite a while. So an IBM, Microsoft, Starbucks, any stock that's weathered the storm probably has better management than somebody just starting. And they're entrenched in the marketplace. They own the market. General Mills owns the market of breakfast cereals and foods. Kraft or Altria, they own that market. It's really hard to compete with them. It's not hard to compete with an upstart company. In fact, they attract competition. People go, oh, they're making a lot of money. Well, we can do that as well. So everybody gets in the same business, and now it's a more difficult market to be in. So I love stocks like good wine. The longer it's aged, the better it's going to be. Well, we've run a lot of studies on the market. I'd like to share these studies with you. This is all original work that we were able to do. Kind of an interesting story I'll share with you. All the data you're going to see is from something called Quantitative Analytics. It was a software company that three of us started, 18 years ago, maybe a little longer than that. Quantitative Analytics was sold out to Thomson Reuters, and you can subscribe to Quantitative Analytics. It's a lot of data, a lot of ability to manipulate data. Mutual funds subscribe for about $30,000 a month to the data and to the software programming of it. But three of us, a guy named John Stafford, a legendary commodity trader, Blair Hull. Blair was the first guy to have the handheld option calculators on the floor, and myself started this company, in part because my great friend Tom DeMark said, hey Larry, these guys need some help, let's go talk to them. So I did, and was one of the three founders of Q&A. So I get to use all this software for free and ask all these questions. It's been an invaluable tool to have. What a serendipity event. But as a little aside, a little historical aspect, Blair Hull was fascinated with me because I had run for the United States Senate in Montana, narrowly defeated in 2 elections. Blair Hull decided he was going to run for the U.S. Senate in Illinois. So he did, he filed, he was way ahead in the polls. I mean, nobody was close to Blair because I'm worth $500 million. About all the TV time, in Chicago, they're known sometimes to buy off politicians, I think. I don't know if that's true or not, but many of you Chicagoans here may have heard of that. So Blair was entrenched, far ahead in the polls. They had a Republican, handsome, good-looking Republican, doing really good as a Republican. Maybe he could beat Blair. Then the Republican's wife came out and said, well, yeah, we used to go to the swap club down on Wabash Street or something. The Republican swap club? Well, that's not really a good Republican group to appeal to. He dropped out of the race. So then Blair Hull's former wife said, well, he used to beat me up. Here's a picture of it. So Blair Hull dropped out of the race. And the Democrats had just like 1 or 2 guys who were going no place. They had no money, weren't going any place at all. But the only guy left in the race was a young guy named Barack Obama. Had Blair Hull's wife not gone public, or had he not, whatever happened there, Barack Obama would probably still be in the State House in Illinois. Who knows where he would be? But the pivotal point in his career really was Blair Hull dropping out of the race, and Blair Hull was the next U.S. Senator from Illinois, without a doubt. He was so far ahead. And as Paul Harvey and other good Chicagoans say, that's the rest of the story.